One.
Hey everyone, welcome back to another episode of the Integrating Investor. I'm Seth Levine of the Integrating Investor website and stuff up there, as you guys all know. Welcome, thanks for joining me again. Happy to continue with our show. Looking at the screen up there, I could see got a little map burn again this week, so try to abstract that away. As you know, I believe it was Sun Tzu who said, if you don't want map burn, don't leave the house. So I don't know what to tell you. Sorry about that. Hopefully it's not distracting. So we are going to continue along this journey, right? We're going to flesh out the difference, kind of a different view of money in central banking, and really it's going to, I think, should lead to a lot of investing concepts that we can revisit down the line. So there's a payoff here. And really, we're doing this because rethinking our definitions and concepts is going to lead to better understanding of markets and economics, right? And this should all make us better investors, right? And now I know it's going to be tedious, and maybe it has been tedious, but at least for me, like, there's been a pretty big payoff in doing this. So I hope you guys all kind of get the payoff as well. And as we go through this, again, please, feedback is very much appreciated. Again, we're kind of going through this, something that's not typical. Maybe it's not typical for a reason, but hopefully this is a journey of exploration, and any feedback on a journey is always appreciated. Next week, I'm going to air my interview with Daniel Want, as I've been teasing a little bit here. Daniel is the Chief Investment Officer and a co-founder of Prerequisite Capital Management, which is an Australian investment management firm. I just kind of watched some of the interview there. I mean, it was just awesome. We got into all sorts of abstract investment processes discussions. We're talking about complex system dynamics, which is really Daniel's specialty. So it's pretty cool. It is long though. We covered a lot of ground, and if you notice, kind of midway through it, my earbuds died, so I had to kind of switch them out, and I think I did it, pretty stealthily, if I might say so myself. But that's it was long. But really, what stood out for me and what I just love about Daniel is kind of two things. I mean, there's so many, but really like top two is Daniel really, he takes ideas seriously, right? And that's something I really appreciate, right? Just taking ideas seriously. And you take ideas seriously and you combine that with, even as Daniel brought up, the law of non-contradiction, right? We know this from philosophy, and if you don't, feel free to ask. And when you take ideas seriously and you take the law of non-contradiction seriously, you start finding a lot of questions, right? And you start uncovering, maybe there are clues that maybe your understanding of the world is a little bit, isn't as tight as it should be. And really, that's the theme of this money series, as I've sort of as you will see, and as I've tried to portray. As always, please like and share this episode. I see we got a couple likes already. Thank you so much for doing that, everyone in the chat there. As always, just hit the like button if you're watching this, and if you don't like it later, unlike it, thumbs down it, whatever you think it deserves. But this way, if you like it now, you don't have to remember later to do that. Also, you can follow me on Twitter, as always, where I hang out up there. Check out the website, as always. You can subscribe to get my monthly emails, my monthly articles emailed right to you. And of course, there's a super chat. Feel free to please use the super chat and help out the Ayn Rand Center. As always, email me show topics, or if you have guests who you'd like to see interviewed, you can love to hear those. Again, you can put them in the comment section, not the super chat, the comments. You can hit me on the website using the contact form, or you can email me at info@integratinginvestor.com. That's info@integratinginvestor.com. And again, if you are a philosopher with an expertise in epistemology, or if you are an economic buff and you have an expertise in the history of money, please reach out to me, because I think there's kind of a cool project to do here, kind of on this money series. And maybe, we could collaborate on something, I don't know. So yeah, so without, further ado, we will go to the, where is this thing? To disclaimer, of course, these are just personal opinions, not investment advice. Really doesn't even pertain to the show here, but do your own work and, yada, yada. So moving right along. So just to recap where we've been, right? So last show, I tried to set the context, right? I traced my inquiry back into these topics of money, central banking, and investing really back to 2013. I mean, it kind of extends longer, but that's really the kind of where I jumped on this path and took it like as a serious subject for study. And it really, for me, it all started because I saw this disconnection between theory and reality in the macro investing space. And it was very stark around this time. Again, this is 2013, right? This is, QEs have started, right? The quantitative easing program from the Fed, and there were all these inflation predictions, and very dire inflation predictions because the Fed was so active. They were printing trillions and trillions of dollars, the likes of which we've never seen. Really, all that inflation really never really manifested. Now, let's just put asset inflation aside, which I think is kind of a separate issue. But that sort of goods, the CPI inflation never came. There were people who were going to say, claim the dollar was going to collapse, right? The US dollar is going to collapse with all the money printing. And really, I mean, the dollar kind of strengthened, if you kind of look at it, it kind of, ebbed and flowed over that time period, but it really hasn't collapsed. That's for sure. And there were stock market bubbles, right? There was all sorts of stock market fears about it was a bubble and the money printing, again, all kind of tied to the Fed. Hasn't really hasn't really happened. We've had ups and downs, but haven't really seen like a bubble burst type of thing. And I personally saw this scary bond market bubble. And now that's either continuing to this day, or maybe it's something else. My opinion on that is a little bit more open, kind of open than what it was when I started. So anyway, there was a lot of bad and logical sounding stuff that was predicted around, the 2013, 2014, since then, but really nothing really manifested. That's not to say that all is well right now, but rather, it just raised a series of red flags for me that indicated that my understanding kind of needs some exploration, right? In other words, like I basically faced a moral dilemma, right? I could evade the fact that none of my expectations really played out, or I could, face my fears. And luckily, I kind of opted to face it. So I started looking at the history of central banks. That's just where I started. I came across the Objective Standard article in 2013 called "The End of Central Banking." Great article. And for me, it really helped provide some historical context for central banks, right? If you look at the history of central banks, I mean, when you look at what their purpose was throughout time, right, the Fed isn't the first central bank. In fact, it's probably one of the later manifestations of it. The purpose of all central banks was really to fund the government, full stop, right? Nothing else mattered. They were created to fund government expenditures throughout history. So that gave me that perspective. Then I came across some Cato papers and the website altm.org, which again is fantastic for me, the history of banking, right? I love it for the historical stuff. And that sort of path introduced me to the concept of free banking, right? And how free banking worked throughout history, how it was tried, even though it wasn't really anything near laissez-faire, it was still freer than what we have today, which to me I just never knew. So that gave me that kind of perspective. And then I was also reading about the history of the Fed's founding, right? Why the Fed was founded. And again, it kind of followed the panic in 1907, but the Fed wasn't founded until 1913, right? Almost, half a decade later or something like that. And, if you look into it again, it was very political, right? The reason for the Fed was, founding of the Fed seemed to be more political than economic, in my view. So really, when I looked in, kind of this perspective just started to paint this picture that this modern conception of a dual mandate, the Fed has this dual mandate of stable, stable prices and full employment. It's real, to me, it's really just a modern rationalization, right? It's really atypical for a central bank. So armed with this, armed with some historical context, I started turning my attention to the Fed and what it was doing today. And really just the onslaught of kind of market interventions was new, right? That was going on, right? We'd never seen anything like that before. We saw QE1, then QE2, then QE3, and then, depending on if you want to keep counting or not, QE4, plus. I mean, the Fed has not stopped. If anything, the balance sheet has only continued to balloon. The Fed started paying interest on excess reserves because it had reached a zero bound with their the Fed funds rate, so they needed a way to control high-powered money, as they say. We saw negative interest rates in Europe. So just all these new central banking actions, right? And they weren't really consistent with history, but, these were all done. These were all done under the auspice of there being some economic benefit here, right? It was all steeped in monetary theory and economic theory. And you could go back and you could look at it. These aren't necessarily just people trying to, pull one over on everyone. These are academics and intellectuals who are operating within a framework. And also, through this time too, I was also kind of trying to challenge my own instincts, right? I had this instinct too that was very knee-jerk. I wanted to blame everything on government, right? But I have John Tamney to thank. John was on my show in April 23rd of this year, called "When Politicians Panic." Had a great interview with him. John really was challenging my thinking through his writing, kind of saying that markets are smarter than the Fed. The central banks can't control everything. So, I was kind of integrating that too. So I had all these different views, and I really just kind of sucked up and tried to dig in and kind of untangle everything and trying to figure out a better theory for what I had. Now let's say, so I had a few big realizations that I really resisted at the beginning, but ultimately I kind of accepted because I found them to be true. And the first one is banking is a carry trade, right? Commercial banking is a carry trade. And now I kind of covered this on the last episode, so definitely go back and check that out. But as a reminder, banks, they borrow money in order to lend, right? They take in deposits from savers. They pay you for that, right? So there's a cost of that. And then they lend it all out, holding just a little minuscule amount left for reserves to kind of cover their liquidity needs, right? So it's really a leveraged carry trade, right? It's not this warehousing of deposits that I had thought. Like I thought that banks, they take your money and they keep it for you and they kind of lend it out on the side, but they're really just trying to keep your money. No, I had to flip that understanding on its head, and really just that very innocent sounding thing really led me to reformulate all my views about money, central banks, economics, economies, markets, and really, markets is this is the end, right? This is the purpose of why I'm doing this, right? I want to become a better investor. And all this has, I think, helped me along those lines. So with that, just take a quick pause, check out the chats. MA, thank you. Great to see you. Thanks for joining us. And I see your question. Do negative interest rates mean you pay back less than you borrowed? So the way how negative interest rates work in theory is you would basically give someone money and you would earn no money at all. no interest on that, and then you get back less. MA, give me $100, and then in a year I'll give you $98 back. How does that sound to you? Right. So you've actually, it's basically negative interest rates is just really an incurred loss. You just incurred 2% loss on that, right? Or you paid a negative interest rate if you want to get all confusing, but really it's loss, right? It's a very good way of kind of thinking about it. All right, so back to money, right? Money. So as I sort of tease, the Fed doesn't create money in my view, right? So if the Fed doesn't create money, then what does it do, right? I thought the Fed prints money, right? Isn't that what the Fed does? And I mean, to me, no. And this really was a long journey. It's a controversial journey. I don't know if anyone agrees with me, but that's pretty much that's where we're going on this. So because that's where we're going on this, we have to really start with, the first, foundation here, right? What is money? Right? So we need to understand what money is. Because again, what the Fed has done is it's really all steeped in monetary theory, right? There is money to do with it, at least from a thinking perspective. But, so that's where we're going to start. And it's crucial to start with money because of what we know about concept hierarchies, right? In order to build, this comes from the objectivist epistemology. In order to build concepts, we build concepts from concepts. We start with percepts, right? Perceptions. We see things in the world. We see similarities and differences, and we form concepts from them. And then we take concepts, low-level concepts, and we combine those and integrate those into higher-level concepts, and on we go. If you get something wrong, if you get something very foundational, something that seems easy, but if you get that wrong, everything else that relies on your understanding of that concept can go wrong. And we could, illustrate this with an example, right? Let's take the classic, furniture example, right? And this is a classic introduction to objectivist epistemology 101, right? You have furniture, right? Furniture, we know, is a concept, right? It is a concept that is made up of sub-concepts, right? So furniture is made up of the concept desk, it's made up of the concept of chair, a concept of bed, concept of couch, of the concept of table, right? Now, what happens if you get one of those concepts wrong, right? Let's say you misform your concept of table, right? You say, okay, table, tables are not just these things that have legs that could hold something on, or that's suspended that you can hold something on, and it's roughly proportions, to someone's body. Let's say it also includes dishes and cups and maybe the things that go on the table, right? Well, then your concept of furniture would be all out of whack, right? And it would lead you to all sorts of crazy ideas, right? You would say, well, look, I'm going to go to the furniture store and buy some new glasses, right? Because that's what furniture, that's what you do with furniture. And I guess maybe that was a horrible example, because you can get, glasses at IKEA, which is where these are from, which is a furniture store. But, you could see how, you could start to imagine how misforming concepts is completely going to mess up how you think about the world. And I think a lot of people who are watching this, would say, laissez-faire capitalists, who think that is redundant, you could see how your understanding of capitalism as not laissez-faire leads to different views of capitalism, right? So this is the path I'm going down, and we're going to start with money. Again, this is my own kind of unique. This is my own unique hypothesis. I'd love it if someone wants to help me kind of develop and test it out a little bit more. Someone else is interested, you got an expertise, reach out to me and let's do it, because I think it could be pretty cool. All right, so let's we do a bunch of slides here, because I think it's going to really hit the point home here, right? So this is my absolute favorite quote in the world. When we talk about money, this literally always jumps into my head. This is from my friend John Tanmi, as always. Says it like no one else can, right? Money unearths the stupid like nothing else. I mean, I just love that quote. I mean, like most things John writes, he's so direct, which can be brutally honest, but there's also like a real elegance in the simplicity in how simply he states the truth, right? Money on earth stupid like nothing else. So just to see, let's see how confusing money really is, right? Right? Who doesn't know what money is, right? I mean, who doesn't know what money is, right? I mean, anyone in the chat, you guys know what money is, right? I mean, we kind of use it every day. We touch it every day. It just kind of rolls off the tongue, right? But if you it sounds so easy, right? Money, right? But it's a very complicated concept. And it's the fact that it's complicated, to me, is a clue that there's a problem. And really, we can see lots of thinkers struggle with the concept of money and its definitions throughout history. And we're going to look at some right now, right? So this is probably the most familiar understanding of money out there. This is an 1875 quote from 1875, right? Money is made up of there's four pillars to money, right? It's a medium of exchange. It's a common measure of value, right? Or unit of account. It's a standard of value, right? There's some kind of, there's a standard there. And it's a store value, right? We could store it. It sounds simple. You're like, yeah, those all sound about right. Now moving along, 75 years or so since then, we can see Ludwig von Mises, one of my favorites. His definition of money is, a medium of exchange, right? The most commonly used medium of exchange in a market society. So von Mises is saying it's just money is the medium of exchange, right? We had kind of four things. Now von Mises is really just saying, it's just going to be one of the four things, right? Medium of exchange. Few years later, then, another Austrian here, right? Rothbard. He says something similar, though starts kind of sneaking some other concepts in here, right? It's a medium of exchange, the thing that other goods and services are traded for, the final payment of such goods and services in a market. Like, okay, like what is final payment? Okay, so medium of exchange, all right, but what is this? What do you mean final payment, right? Like, like what if I don't know, I'll leave that there, but we could see how the definition is starting to morph. Now, of course, we go to Miss Rand, right? Miss Rand in Egalitarian Inflation, a fantastic essay, now starts introducing, now she's coming back to savings, right? Money is not merely a tool of exchange. Much more importantly, it is a tool of savings. All right, medium of exchange. And now we have medium exchange and medium exchange savings, right? Now, if we kind of keep, this is kind of a step back, but all kind of at the same time, we go to Friedman and Schwartz, right? Very famous monetary economists, free market economists as well. Now they start introducing new concepts of currency, right? Where did currency come from? Bank deposits, right? Where are bank deposits coming from, right? We're not just talking about exchange media anymore, right? We're starting to see a recognition that money has something to do with private banks. Money has something to do with private banks. Like that's not really part of the initial four. We don't see that in, we don't see that in, we don't see that in medium of exchange, savings. Like it's getting very complicated, right? I mean, I hope you can see how it's kind of, I thought we were just talking about money here, right? There are all these sort of claims, right? Now we can go to a totally different school, right? So kind of Austrian, we had, Ayn Rand, of course. We have the early monetarists. And now here's, we start going to move into the new Keynesians, right? Here are some guys, money is really just paper that the government prints. Oh, money just, the government buys goods and services and pays for them with money, which is really just pieces of paper that the government prints. Right, so money now comes from government, right? That's now another sort of angle that we're seeing. Now just going, kind of, this is going to take us full into MMT right here. This is Randy Ray. He is one of the founders of MMT. Ray says, money is debt, right? Money is always debt, right? It cannot be a commodity, right? Because if it would, that would mean that a particular good is buying goods. Wait, good is buying goods, debt. I don't know. It's getting all pretty confusing here, right? What happened? What we thought was just this very simple concept of money, something that we touch and use every day, is it's these serious thinkers. I mean, these are serious people, right? Whether you agree with them or not is a separate story. These are serious thinkers, or cannot even come, like, we're not even in the same ballpark now of having a common overlap here in definition. Now, I could have picked, I don't know, hundreds of quotes, right? Pick your favorite economist, pick your least favorite economist. They probably said something about money. That was just kind of, I just kind of picked those real quickly. And to me, like, clearly we have a problem, right? The definition of money is just all over the place. Like, how on earth can we possibly use a definition that has or how can we use a concept whose definition is not universal, right? The whole purpose of definition is to help us define concepts. And the whole purpose of concepts is to use them in the real world. Because again, we build concepts from concepts. And money is a foundational concept when it comes to economics and investing, right? If you get this wrong, you're going to get a lot of other stuff wrong. And to me, this is most evident in inflation, right? Inflation is another very foundational concept, right? I did a couple of episodes on inflation. I have a very different view of inflation than most people have today, but that's because I have a very different view of money than most people have today, right? And I covered inflation in a June 4th and a June 11th episode show. It's called Is Inflation Still Inflation? And What's Behind Today's Inflation, right? That's June 4th and 11th. So in my opinion, it's this bad definition of money, which is really leading to our like primitive understanding of a lot of economic issues. It's kind of embarrassing, especially when you consider other kind of other sciences out there. But to me, though, there is a commonality, despite all that range of definitions, right? From government printing stuff to debt, to a medium of exchange, to savings, right? To even private banking, there is a conceptual common denominator, right? That conceptual common denominator is implied in all the definitions, right? Money requires some common understanding of value, right? Even if it's personal, money has something to do with value, right? And go back to all those examples, right? How are we using money, right? We're measuring something, right? Like you and I, like we're measuring something. Now it may not be like, in a strict sense, but we use money to measure. But, measure what, right? If a medium of exchange, a savings, a government print, right? A currency account, right? These are all measuring something, and that something that is measuring is economic value. Now it's implied, but it's not explicitly stated really in any of those, right? Let's go back to our definitions, right? What are we exchanging? What are we storing? Think about it, right? What are we measuring, right? These are all measuring, right? So money to me has something to do with measurement. Money is measuring what? It's measuring economic value, right? So I think we could get a better definition of money. And once we have a better definition of money, I think we can form better financial concepts. I think we could clean up the messy ones that we already have, like inflation. We could better understand the world. And ultimately, what this is all about is we can be better investors. So that's a lot right there. So just for everyone watching, welcome to my journey, right? Welcome. This is going to be a journey, choose your pill. What's it going to be? The red or the blue pill, right? This is just a hypothesis, of course. I don't know if it's right. I'm kind of working through this all myself. I obviously suspect it's right. Otherwise, I wouldn't be doing this at all. That would just be insane. And I don't think I'm insane. Pinch me if I will. If you think otherwise, if there's anyone out there who wants to kind of help me flesh these ideas out, you got a expertise in epistemology, you got a real tight kind of monetary history background, let me know. Like, I would love to kind of really work through this. So with that, I think kind of end it there. Check the chat. No, chat looks good. Guys, thank you for liking the show. That is huge. As a reminder, I'm going to air my interview next week with Daniel Want. I'm going to try and tune in live. There is going to be a super chat on that. So you will be able to kind of ask questions either during the super chat. You want to ask, during the show in the comment, use the super chat function. I'll make sure to get Daniel's answer. He is an awesome thinker. I think I loved it. I hope you guys all love it. Just trying to, I don't mean to break this up, but just trying to stick to the once a month kind of interview schedule. But we are going to pick up this concept of money and continue down this path the week after. So I'll see you next week in the chat, and I'll see you in 2 weeks live. And as always, guys, thanks for joining. Thanks for keeping an open mind, and have a great weekend. Take care.